Ever thought investing in real estate was a fail-proof strategy? Think again. Today we're diving deep into the 7 mistakes beginners make when investing in Dallas real estate. Picture this. A bright-eyed investor, let's call him Jamie, steps into the Dallas market with dreams of big returns. Armed with enthusiasm but lacking the roadmap, they're about to step on every landmine along the path. So why should you stick around till the end of this video? Because Jamie's journey is a treasure trove of lessons that could save you from falling into the same traps. We'll dissect each mistake, backed by data and real-world examples, guide you on how to avoid them. Whether you're eyeing your first property or looking to expand your portfolio, this video is your complex world of real estate investing. So buckle up and let's navigate this journey together. Let's kick things off with the first major pitfall: not doing enough research. You see, diving into the Dallas real estate market without a solid understanding is like navigating a ship in the storm without a compass. The market's nuances, from neighborhood dynamics to economic trends, are crucial. Did you know, for example, that certain areas in Dallas have seen property values double over the last decade? This isn't just luck, it's about understanding where and why these areas are growing. And yes, there are areas in Dallas that are also declining, not the overall Dallas market, right? But there are certain spots you gotta be careful about. So market research isn't just a preliminary step. It's an ongoing requirement. It involves analyzing market trends, understanding the demand-supply dynamics, and keeping an eye on future developments that could affect property values. Tools like the MLS, right? The multiple listing service, real estate websites, and local government resources can offer invaluable data. Yet, many beginners skip this step, relying instead on hearsay or surface-level information. You have no idea how often I'll hear someone say, "Yeah, but my friend's uncle's cousin told me that this area is really booming." I'm like, okay, how many properties does that person own or has dealt with in that area? Exactly. So, you need hard data, not just someone's opinion who just thinks, oh, I heard this in the news, so it's got to be like this. There's a lot of information that's going on out there that you just have to be careful about, and you have to sift through it, okay? So imagine investing in a property because you heard that, hey, Dallas is growing. Without any context, such a statement is misleading. Some areas may be booming, while others are stagnating or even declining. Lack of research could land you in a property in an area with poor rental demand or declining property values. Always remember, data is your friend. For instance, the Dallas-Fort Worth area is expected to grow significantly in population over the next few years, but this growth isn't evenly distributed. Knowing exactly where the growth is concentrated can make or break your investment. Moving on to the second mistake: underestimating expenses. It's easy to get caught up in the potential returns of real estate investments and overlook the costs involved. Expenses like property taxes, insurance, maintenance, and unexpected repairs can significantly eat into your profits. Dallas, with its varied property types and neighborhoods, presents a wide range of expense profiles. Many beginners fail to account for all the potential expenses. Beyond the mortgage payments, there are property taxes, which in Texas are higher than many other states. Then there's insurance, maintenance costs, and potential homeowners association fees, right? The HOA fees. Not to mention, if you're investing in older properties, you might face significant repairs and renovation costs to make that property appealing to renters or buyers. So consider the case of this investor who bought a property in an older Dallas neighborhood, attracted by its low purchase price. They didn't account for the expensive renovations required to bring the property up to standard. The initial budget was blown out of the water, turning what seemed like a good deal into a financial drain. And it's crucial to have a comprehensive understanding of all the potential expenses and ideally set aside a contingency fund for unexpected costs. That's one of the main reasons I usually recommend new construction homes in growing neighborhoods. Builders will provide you with a bunch of warranties, so your maintenance cost is minimal for the first few years of ownership. Optimism is a great thing. It's a great trait, but when it comes to real estate investing, realism is better. The third mistake is overestimating returns. The Dallas market, while offering substantial opportunities, also requires careful analysis to accurately predict returns. Factors like the local economy, job market, and rental demand directly influence your potential income. Setting realistic return expectations involves understanding the market's rental yields and appreciation rates. While Dallas has seen strong growth in certain areas, others have plateaued. The key is to base your expectations on solid data, not wishful thinking. For example, While the average rental yield in the Dallas-Fort Worth area might be attractive, your specific property's location, condition, and market demand will ultimately determine your actual returns. Now, speculative investments based on the hope of rapid market appreciation are particularly risky. Dallas, with its dynamic market, can tempt investors to gamble on quick flips or areas rumored to be the next big thing. However, without substantial evidence supporting these bets, you're more likely to end up with a dud than a diamond. Remember, in real estate investing, patience and due diligence pay off far more than chasing the latest trend. So hey, if you're getting value out of this video so far, please hit that like button, drop me a comment below, and subscribe to my channel if you haven't already. And also hit the bell so you don't miss out on any of my future videos about investing in Dallas real estate. The fourth mistake is underestimating the importance of location. In real estate, you know the adage, location, location, location holds true. Especially in a diverse market like Dallas. The value of a property, its rental demand, and the potential for appreciation heavily depends on its location. Yet, many beginners are tempted by lower prices in less desirable areas, overlooking factors such as neighborhood safety, accessibility, and local amenities. The right location can mean the difference between a property that consistently appreciates and one that stagnates. For example, areas close to major employment centers, universities, or easy access to Dallas's main transport route tend to have the higher demand and can command higher rents. Conversely, properties in areas with limited economic activity or poor transport links may have lower rental demand and slower appreciation. Top performing areas in Dallas, such as Frisco, Plano, Melissa, and Princeton, offer a mix of strong rental demand, good schools, and excellent amenities. These areas have seen consistent property value appreciations. On the other hand, investing without considering location can lead to purchasing in areas with high vacancy rates or in neighborhoods on the decline, which can erode your investment's value over time. Mistake number 5 is a common oversight for many investors, which is failing to plan for vacancies. Vacancies are an inevitable part of owning rental property, and they can significantly impact your cash flow if not properly accounted for in your financial planning. Understanding the average vacancy rate in your target area is crucial. Even in high-demand areas of Dallas, it's realistic to expect that your property may be vacant between tenants. During these periods, you're still responsible for the mortgages, the taxes, and upkeep of the property without any rental income. Planning for these vacancies by setting aside a portion of rental income during occupied periods can help mitigate that impact. Minimizing vacancy periods involves proactive property management, such as marketing the property effectively, keeping it in good condition, and setting competitive rental prices. Building good relationships with tenants can also encourage longer stays, reducing turnover and vacancy rates. Choosing the wrong financing method can have long-term consequences on your investment's profitability. The sixth mistake is making poor financing decisions, often due to the lack of understanding of the available options or being swayed by short-term benefits without considering long-term costs. There are multiple financing options available for real estate investors in Dallas, including traditional mortgages, hard money loans, and private lending. Each has its advantages and disadvantages, depending on your investment strategy, financial situation, and the property itself. For example, while hard money loans can be quicker to secure for flipping projects, they come with higher interest rates and shorter repayment periods, which can eat into profits if not carefully managed. Securing financing without fully understanding the terms and implications can lead to unsustainable debt levels, negatively impacting your investment's cash flow and growth potential. For instance, adjustable rate mortgages, right? The ARM mortgages might offer lower interest rates, but can significantly increase over time, affecting your profitability. The final common mistake is neglecting the importance of property management. So many talks that I have with people all the time that want to property manage themselves versus getting a property management company. So whether you decide to manage your Dallas real estate investments property yourself or hire a professional, effective property management is key to maintaining the property's value and ensuring a steady income stream. Okay, I'm going to be putting out a video fairly soon about why and how a good property management company can actually increase your ROI. So you don't look at the expense of it, but it'll actually make you more money using a property management. So make sure you subscribe to my channel so you don't miss out on that video when I put that out. Okay, it's going to be very, very soon. I've already planned it out. So good property management includes regular maintenance, prompt repairs, tenant screening, and effective tenant communication. This not only helps in maintaining good tenants, but also in preserving or enhancing the property's value over time. While managing the property yourself can save you on management fees, no doubt about that, right? But it requires significant time and effort. Professional property managers, on the other hand, can handle the day-to-day operations, allowing you to focus on investment strategies, right? And other things, because you actually have other work to do, right? However, choosing a reliable and efficient property management company is crucial, as poor management can lead to tenant issues and property neglect. As we've explored these common mistakes, it's clear that successful real estate investing in Dallas requires careful planning, thorough research, and strategic decision-making. I've helped a lot of first-time investors purchase rental properties in the Dallas area, and I invest in rental properties here myself. So, if you're considering buying an investment property anywhere in the Dallas area, make sure you give me a call, shoot me a text, send me an email. I would love to help you come up with a plan that works specifically for you. And if you found value in this video, please give it a like, drop me a comment below, and subscribe to my channel and hit the bell so you don't miss out on any of my future videos. I will see you on the next one.